Okay, let's start. Good morning. So we have covered all the topics we're going to cover before midterm and everything that's going to be tested. So I have a draft midterm at this point. It includes 7 questions. It's only 2 hours, but that's the draft midterm. It's this Friday, starting I think at 10 o'clock until 12. You just log into your Brightspace and it's just very similar to the quiz you did before, except this time we all start same time and we have 2 hours to do that. The format, so the last quiz has a written question and it's very revealing. So midterm will be, at this point, all 7 questions are written answer questions. So you actually have to write your answer and then in the little window to give it to you. Okay, any questions? That's so far what I have. 10 to 12 on Friday. 10 to 12 on Friday. Yeah. Okay, so we have 2 classes to review. So if you have a question, you still have a chance to answer, right? So that's just a start with today we will focus on the last chapter we just did because like it's fresh in our memories, and I just like went over your last quiz, and so I have some feedbacks. So let's just start from there. Okay, so this is one of the questions. I have to say this time we like the marks are lower than the first 2 quizzes because like this one has more substance. Previous ones were just a quick review afterward. We more focused on the concept, right? So this is one of the questions I want to spend some time going over 2 of the questions in the in the third quiz, and then combine the review of the chapter that way, and then we'll go on to do more like a kind of a review by solving problems. That's the plan. So this one, we are presented with this schedule. So we learned that there are 2 schedules we prepared very similar. One is we convert accounting income to taxable income, right, to determine tax payable. So that starts with accounting income. The second schedule we have prepared several times is the income tax section of the income statement, right? And that's like also starts with the accounting income, but then you subtract the taxes you already determined to determine net income, right? That's the bottom part of the income statement. They're very similar. So this is the first one. So we're giving pre-tax accounting income, and there are 2 adjustments. One is the dividend income from another tax-paying Canadian firm, and one is this, they call it a depreciation expense, which will reverse in equal amount in each of the next 4 years, and then subtract $400 here. So we're giving taxable income of $450, and tax rate is 25% for all years. Okay, and so the first question was I think this is a multiple choice question. They are given current income tax and deferred income tax, and you give you 4 choices of a different combination of numbers, and then ask you to choose the right one. So it's about 50% of us got it right, 50% of us did not get it right. Now, with that multiple choice question is that you didn't get it right, doesn't mean you didn't get anything right, right? Because you have 2 numbers, you could get 1 number right or 1 number incorrect. Okay, so let's just review this. So the first one is in current income tax expense. Now I find, because in this written answer question, you actually have to write your answers, there's huge confusion in terms of the terminology. Okay, people either they don't use any terms at all, they just stick you a number. Now for the quiz, I go really lenient. Like I would just, if the number is correct, I assume you just forgot to written it. But I know that's probably less than half the case, because deferred tax asset and deferred tax liability, they're not the same thing. Far from it. They're opposite. So knowing it's deferred tax asset or deferred tax liability is hugely important. It's really important. Not knowing that, you can't say you know the solution to the question, right? So the written answer, there's a huge confusion in terms of terms. Okay, so here, what is current income tax expense? Like, I'm not saying, like, I have current income tax expense. If you use the current tax expense, it's wrong. No, that is correct. It's like something totally irrelevant. Some people would like do not differentiate between income tax.
You only need police record if you're traveling throughout.
Someone please turn the mic off.
If you don't have a.
Oh, Aaron. Okay. Where was I? Okay. Where was that? Oh, okay. It was just like you know, like the term is really wrong. The term we never used in this class all means something opposite. That kind of wrong, right? So to make matter worse, for the same thing, we often use different terms, and all of them are acceptable. Like, you know, so that just makes matter worse. So this current income tax here, okay, I will just use it here. So the other terms for this one is actually, what is that? Would actually include things like this is weird. Never mind. I will just income tax payable. So when we say income tax payable, be very clear. When we calculate the income taxable as a result of that schedule, that is current income tax or current income tax expense. So what it means is the taxes or maybe tax that is due for the current period. Okay, so knowing how things works can really help here, right? So the income taxable, current income tax that is due for the current period. One, is it paid? One, is it paid? At the end of the period? In theory, that should be, right? However, if you think about it, you don't know exactly how much tax you should pay until the period ends. And then human takes time for us to get all the documents together and get it all sorted out and prepare a tax return, right? So like we do personal income tax, we know for 2020, it's not due until end of April, right? So that, but for corporations, because like the tax, first of all, our employer already deducts a lot of the tax we should pay, right? And then, I mean, none of us are billionaires here. So like the tax is small anyway. So that's all right. Then we wait until April 30th to sort it out. But for corporations, because we're talking about larger amounts, so depending on the size, you have to pay installments, right? Actually, you don't need to be big size, you need to pay installments. So maybe every quarter you should estimate how much you need to pay, and then so this current income tax, tax payable, by the end of the year, typical situation would be lots of that is already paid, but not all, because you do not know the exact amount until the its end, right? So at the end of accounting period, so this income tax payable would be partially paid. What's remaining would be shown on the balance sheet as tax payable, which is separate from deferred tax. Does that make sense? So that's how it works. So like if it would be nice, it would be a lot easier to kind of deal with if like the tax payable is paid instantly by the end of the year, because we also say this current tax has cash flow impact, because you actually pay. However, usually it's not 100% paid by the end of the year. So that's the difference. It would be the change in tax payable. Okay, so that's how it works. Does that make sense? Okay, so let's be clear what it is. And then, so for this question, so this current, since we're asked current income tax expense would be the same to all above. They're just all the same thing. Is simply that we were already given 450,000. That's taxable income, right? That's the taxable income you worked out on tax return at 25%. So I think it's, I don't have the number here anymore. I think it's 11 or 10,250 or 11,250. 11,250. So that's the current income tax. Oh, 112. Okay. Okay, thank you. Okay, so that's that. And so I think we're okay with that, most of us. I don't think that will be the challenging part. The challenging part is this deferred income tax. It's deferred income tax, right? So, you know, this kind of a, how do we know? Well, we know deferred income tax is caused by temporary difference. And there's only one temporary difference, and that is shown in this part. Depreciation expense, which will reverse in equal amount in each of the next 4 years. So this 400,000 is subtracted here. So it is essentially by subtraction here, it implies that amount to be deducted for tax purpose is $400,000 more than for accounting purpose. So the other expression of this item would be excess CCA. That means CCA is $400 more than depreciation expense. Does that make sense? Yeah, CCA, capital cost allowance, is the amount you're allowed to deduct for your PPEs for tax purpose. Depreciation expense is the amount you deduct to compute accounting income. So we're converting accounting income to taxable income. We adjust for the difference. Now we deduct 400,000. That means you can deduct $400,000 more for tax purpose. And in the future, CCA will be less than depreciation, right? So the adjustment will be reversed. And so in the future, in the next 4 years together, the taxable income will be $400 more than accounting income, because all these will be add back, subtracted here, add back. So that means $400,000 more will be taxable, because taxable income will be $400 more, right? So deferred tax would it be here, would it be, let me see, 400,000 at 25%. So that is 200,000. Huh? Sorry?
It's $100,000.
Oh, it's 100,000, sorry. 100,000. Okay. So, so that's, we did a lot of like from accounting income adjusted to taxable income, but what we're doing, what these adjustments mean, and what are the implications to future income tax, right? So now we kind of look at this question and just take it a little bit further to kind of have a clear interpretation to these adjustments. Any questions? Okay, without a question, we'll move on to spend a little bit more on deferred tax. So I will ask you a question. I will create a poll here. I don't know what you guys are going to do. The fellows who sign up here can oh geez. You can kind of show a hand or something. So I will create a question. So, okay, never mind. So I'll create a question. Say two options. So under deferred or future tax approach, that's how the approach we use for to determine deferred tax. So deferred tax asset liability is determined first, and then deferred tax expense benefit. So that's one option. So okay, the second option is the opposite. So deferred tax expense and benefit is determined first, and then deferred tax asset. You can't be both, right? And the liability. So which one is the first? So I'll save that. Okay, I saved that. Where did it go? Oh, here it is. Launch it. Okay, so if you are joining us via Zoom, you can send in your answer. Okay? We can see it here, they can't. You can't be both. And you can't say, eh, doesn't matter, I don't care. You know, I'm easy. It's really important. So I will count 5 and I will end the poll. If you still want to have you say 1, 2, 3, 4, 5. So I end it. And I will share the results so you can see the vote as well. It's 1/3 says determine the deferred tax expense benefit first, and 2/3 says, well, asset liability first. What do you guys think? First one, you're not influenced by what you see?
No, perhaps.
Okay, why?
Should the expensive benefit change in the accident?
What was the theme of this chapter? What did we review before we start this chapter? Two different views.
Oh, yeah.
Right? So we reviewed, yes, asset liability view. That dominates right now. So if you have choose deferred tax asset liability first and then deferred tax expense revenue, then you are correct. And not only you are correct for this course, that is the approach in a lot of things. Because when there's when we measure, the measurement principle is you measure balance sheet first. It's also called the balance sheet approach, right? You measure assets and liability first. Change in assets liability give rise to revenue expense. So that's how it goes. If an asset increase, you either have revenue or have a gains because you have more resources. If your asset decrease, then either you have a loss or you have expense. Okay, so that is the kind of like a guiding principle between this part of the chapter, right? So because of these differences, like a taxable difference means in the future, we will have to pay tax on this deferred amount, the difference amount. So since we have to pay tax on this amount going forward, we have a liability. As a result of recording the liability, we end up with the current tax expense. Okay, whereas deductible difference is these amounts are taxed now. And in the future, they will be deducted since they're taxed now, they will be deducted to determine taxable income. Okay, so as a result of that is sort of like have a prepaid tax, right? Have a prepaid tax. So you have a deferred tax asset. In the future, these tax you don't have to pay again because you already paid. And so in order to create a deferred tax asset, you end up recording deferred tax benefit. So that's what it's why we start out reviewing the asset and liability approach before this chapter, and because that is really important. Lots of times in this chapter, in lots of situations, the two approaches give you the same results when the things are simple. Right? However, that's not always the case. Okay, when the tax rate is different in future years, if you start with the tax expense or benefit first, you'll get a wrong answer. And so that's why doing things right away will make sure you always get the right answer. Okay, so that's I'll stop that. Okay, so back to this one. So this is the next question here. Next question here. I kind of changed the question just a little bit. so you in order to answer these correctly, you need to kind of understand it, not just because we have lots of example. If you just kind of copy it over, it doesn't help you, so I changed it a little bit. So this one is McIntyre. There are two different versions. So depending on which version you had, your answer, your quiz may not be exactly same, different in numbers, right? So McIntyre sells household furniture on an installment basis. Customers make payment in equal monthly installments over a 2-year period with no down payment required. For book purpose, sales revenue is recognized at the time the sale is made. For income tax purpose, however, the installment method is used. There are no other accounting and income tax differences. I think there's an extra word. The McIntyre's income tax rate is 30% for all years. Okay. McIntyre reported net installment sale receivable of $300,000 for December 31st, 2020, which is a $100,000 increase from January 1st of 2020. Okay, so what's the income tax to be reported on statement of financial position, and what's the deferred tax to be reported on the income statement? This is the question. Not a single person answered to say this is the amount to be reported on balance sheet, and this is deferred tax liability or deferred tax asset. Okay, most people just give me a number, and some people unfortunately put down the number, but it was wrong. Put down the account, but it was wrong. So I can see why people don't want to say it's a deferred tax asset, deferred tax liability. You kind of got lucky this time, because by nothing indicated what's wrong, for lack of information, I give you the benefit of doubt. But in the exam, you must tell me. You must tell me what that is. If you don't tell me, there will be no mark, because you really did not give me the solution to the question if you just stick to that number, right? You really did not give me a solution. So as I said, this is one. And to think in that way would also help you, because, the more question you have now, the more confusion you have now, the more you learn. Seriously, I have been teaching for over 30 years, and I always know the students seems to be so confused, and they have all kinds of questions. End up doing very well. The students really scared me. Just go, I got it. I know everything. Then I know that's you underestimated the challenge, right? So more question you have now, the better. Okay, so this question, first of all, let's unpack the information that's given to us, right? So there is a warrant installment receivable. Is that installment receivable at the beginning? So installment receivable on January 1st is $200,000. So that means there is a deferred tax to start with, right? If you already have installment sales at the beginning of the year, at the end of last year, means that you installment revenue cumulatively is $200,000 more than the taxable income, right? There were $200,000 revenue already recognized, but not taxed yet. Okay, so if this amount is already recognized revenue, but have not been included as taxable income yet, is this a taxable difference, or this is a deductible difference? So the question is, will this amount increase or decrease future taxable income? Increase. Increase. Is it clear? When the payment is collected, they're taxable, but they are not revenue anymore because revenue is already recognized. So the answer is this amount will increase future taxable income. So that means this is a taxable amount or this is deductible amount? This is a taxable amount. And that means this, as a result of this, do we have a deferred tax liability or deferred tax asset? Liability. So it resulted in a deferred tax liability of what? What's the deferred tax liability? What's the tax rate? I forgot. 30%, right? So deferred tax liability of 200,000, add 30%. So that's 660,000 on January 1st. That's there, right? So on December 1st, no, December 31st, okay, installment receivable is what? 300,000. Now we all did all that work. So now we can say, what do we have at the end of the year? Deferred tax liability or deferred tax asset? Liability. Like there's no change in nature of the situation, just now the amount is higher, right? So we have so therefore deferred tax liability on December 31st equals to 300,000, add 30%, so that is $90,000. Okay, so here's the answer. This part is only, is a deferred tax asset or deferred tax liability? What's the amount? So the answer is on December 31st, there will be a deferred tax liability of 90,000. So I do get lots of 90,000, but and I get some deferred tax assets 90,000. And I don't think if you have done an overlook, let me know. So at least I know I have one success or two successes, because so far at this part I failed 100% because no one said deferred tax liability 90,000. Okay, it's much for you as for me. I want some kind of affirmation that something went through. Okay, so the answer would be, if you wanted, the proper answer is the deferred tax liability on December 31st is 90,000. Okay, so that will be, this will be a nice answer here. Complete answer and correct. So next is deferred tax expense. Now, this is really, really important that the change measure and the flow, the change and the flow measure are the same thing. and the level measure, they are not the same thing. And this change flow are different from level. Okay, it's really, really important. And this is something like introduced in 2241. Like conceptually different. So I have people get this part right, but did not get that part right. So think about it. What do you have to do? What change you have to make to give you balance sheet a 90,000 deferred tax liability? You do not credit deferred tax liability 90,000. You don't do that, right? 90,000 is the balance you want to have, it's the level you want to reach, but you are already at a 60 level. So all you need to do is increase by another 30,000. Okay, this is so important. Like I think the first place this show up as important is when you do the allowance for accounts for uncollectible account. Okay, when you do allowance for doubtful account, so the accounting is if you use aging method, you determine what allowance you want at the end. And then you look at what allowance it is right now. And you only need to adjust to the extent the balance is what you want. The balance is what you want is not the adjustment. Okay, the balance you want is not adjustment. The balance you want is where you want to end up with. You have to look at where you are now. If you have more than that, you adjust downward. You have less than that, you adjust upward. Okay, it's usually allowance is a credit balance. If you have a debit balance, you first need to adjust enough for it to be zero and then become a credit balance. So it's hugely important here. It's not just important for this question, it's definitely important. This is another thing. I'm going to make it a theme in some kind of review because when you walked out the St. Mary's with the a degree major in accounting, you need to know that difference because otherwise people will question your accounting knowledge, question the foundation of your accounting knowledge. Okay, it's like at the debit and credit, you got to reverse. Okay, so in this case, the deferred tax expense is the change in deferred. So changes in deferred tax liability or asset, just in general, is deferred tax expense or benefit, right? So in this case, deferred tax in this problem, deferred tax liability increased from 60,000 to 90,000. So that is a credit of 30,000, right? So to accomplish that change, you need to credit the deferred tax liability by 30,000, and you need to debit 30,000. That will be deferred tax expense, and therefore deferred tax expense. This is expense is 30,000 for 2020. So this will be the proper answer. It's deferred tax expense. The answer is not just 30,000. The answer should be deferred tax expense is 30,000. Okay, so T account was really good for help this, because if you have a T account, you will see so let's just show this. in a T account. So if you have a T account, so you have a deferred tax liability, right? So you have this account, and this account already have a balance of 60,000, and that's on January 1st. And you want the balance to be 90,000 on December 31st. So you need to make an adjustment. So the adjustment should be 30,000, this plugged in, right? So this should be the adjustment. Okay, 60,000 is level, 90,000 is level, 30,000 is the flow, is the change. So it's like temperature is level. So the account on the balance sheet, the balance will be similar thing like in nature as like a temperature, whereas the changes will be like that. You got a heat wave, your coat stretch, change the temperature, right? So that's two different things. The amount on the income statement and the cash flow, they are the changes during the period, right? The balance sheet is a position at a moment in time, whereas income statement and the statement of cash flow and the statement of shareholders' equity, they all report changes for a period. Okay, so alternatively, if you see that, and another thing, if you want to just journal entry will be a good thing. In order to achieve that balance, you need to credit deferred tax liability, but you need to debit, right? You need to debit deferred tax expense. When you debit, it's an expense. So in this case, it will be 30,000, and you need to credit deferred tax liability, and that will be also 30,000. Okay, so in this midterm, I have two questions for this chapter. One is question that will have permanent difference and a temporary difference. Only one temporary difference. Okay, so that, but there will be a beginning balance. So that's very important. Whatever you calculate as either deferred tax liability or deferred tax asset, that's where you want to be. And the change may not be the balance. So by giving you a balance at the start of the period, you will have to know that deferred tax expense and deferred tax benefit is the change. And the change is different from the balance. Does that make sense? Yeah, so that's one question. And in this question, I only use tax rate, one tax rate. Okay, so when you determine the deferred tax liability, deferred tax asset, it's not necessary to figure out which year it's going to be reversed, because every year has the same tax rate. So to simplify, you only really need that if the future tax rates are different for different years. So you need to know when it will be reversed, because the tax will resolve on the year it's reversed. So the tax liability or tax assets will be based on the tax rate on when it's reversed. But to simplify this, I only have one tax rate. Okay, so one permanent difference, one temporary difference with the beginning balance of the deferred tax assets liability, and one tax rate. Okay, so that's the second question. So I have more exercise to that. Maybe I should just go to the second question without going into detail because you have assignment on that question. So that's the tax loss carry over, tax loss carry back, tax loss carry forward. And in that question, I use different tax rate. Okay, so you still have to know like when you have different tax rate, which tax rate to use. So you still get the chance to show me that. But this question, it's pretty challenging as it is. I don't want to make it super complicated. But you do have chance for that. So there will be the question similar to the one in assignment. Okay, unfortunately, the assignment is not going to be due until after next class. But you know, we have the example in the class. We showed all possible situations pretty much, and we have additional practice questions. So know that definitely there is a question on that. Okay. But I think that's fine. So let's just look at some more of the situations, because to sum it up, in order to determine income tax properly, we need to determine the current and the deferred. And in order to determine deferred tax properly, we need to be able to read timing difference, whether that timing difference, the temporary difference is a taxable temporary difference or it's deductible temporary difference. Taxable temporary difference means the difference will be added, will be taxable in the future. Okay. And then that gives you deferred tax liability. And the deductible temporary difference means the amount will be deducted in the future, will result less taxable income in the future. Okay, and therefore that means more is paid now, and that gave rise to deferred tax asset. Changes in deferred tax liability or deferred tax asset gave rise to deferred tax expense or benefit in the income statement. So seems the whole thing depends on, if we get that cleared, then depends on our interpretation of timing difference, temporary difference, to be able to decide what kind of difference it is, right? So I have like quite a few of the situation from exercise 18.6, so we'll just go over together, right? Not all of them, for instance, we did not apply this to the situation when you have other comprehensive gain or losses, because that's the gain or losses without the corresponding cash flows, right? So that's unrealized gain, you included income, but it's not taxable. But you know, idea is to get solid with the basic situations, and should you require to work in this area, you can expand, generalize it if you have a solid foundation of that. So this is the first one. For financial reporting purpose, the straight line depreciation method is used for plant assets that have a useful life of 10 years. For tax purposes, the CCA double declining balance method is used with a rate of 20%, ignoring the half-year rule. Okay, so at the start, well, if it's a timing difference, eventually the difference between the cost of this plant assets and the proceeds from disposal of the assets will be your total depreciation expense and the loss, and will also be all deductible for tax purpose, right? So it's timing difference. However, when you start out, the amount deducted from the very beginning will be different. And so there's a originating difference. So like at this time, the difference originated. And depending on the situation, the difference can grow bigger, but eventually it will reverse and will reach to the same point, and the difference will be canceled out completely, right? So start from the beginning, there will be a difference. Okay, so given the information, 10 years using the straight line, your depreciation rate will be 10%. Right? So for accounting purpose, you deduct 10%. For tax purpose, you deduct 20%. So year one, you will deduct more for tax purpose than for accounting purpose. And so that's a difference, right? So at the beginning, yeah, CCA will exceed depreciation. Okay, so the difference is what kind of difference? This is really important. Is this a temporary difference? Is it a taxable or is it a deductible difference? It's a taxable, it's a deductible difference. Take a minute to think about it. What's the impact on future taxable income? Do we take more now? Or do we pay less now? So we deduct more for tax purpose. That's correct. If we deduct more for tax purpose, do we pay more tax now or less? We pay less tax. So the amount will be, the difference will result higher taxable income in the future. Yeah, because you have less to deduct, right? If you think about the book value is what you can deduct in the future for accounting purpose, UCC is what you can deduct for tax purpose in the future. UCC will be less because CCA is more now. Does that make sense? This is very important. So the difference is a future taxable difference. This is really important, future taxable difference. And therefore, the difference will result in a deferred tax liability or asset? Liability. Okay, and so well, this is the very beginning, so there is nothing. So here, so therefore, increase in deferred tax liability will lead to deferred tax expense. Okay, so Okay, so if we can look at this question and work out these implications, we should be on the right track for a correct solution. Does that make sense? Yeah, so that's really important. That's one. Any questions? Okay. Yeah, it's a future taxable amount because just think when this difference reverses, future taxable income will be more, right? Because there will be less CCA in the future compared to the depreciation. Now, as we said, we only use the same tax rate for this type of problem so that, you're just focusing on analyze whether it's taxable difference or deductible difference. You don't need to worry about the years that will be reversed. Okay, here's the second one. A landlord collects rent in advance. Rents are taxable in the period when they are received. So this is temporary difference again, right? So it's because not all rent received are taxable and all rent received eventually will be earned. But there's a timing difference because if you collect the rent in advance, you can't recognize it until they are earned, but you have to pay tax when you collect it. So this is, first of all, this is a temporary difference. Okay, so this is a temporary difference. So let's get that clear. The next thing is this taxable temporary difference or deductible temporary difference? Deductible. Because we pay tax now, the amount is not going to be paid tax again when you recognize as revenue, right? This is a deductible temporary difference as it will result in a higher taxable income. As it will be added, the difference will be added, oh my gosh, will be added to future taxable income. Okay, so if it's deductible difference, what kind of, is it deferred tax liability or deferred tax asset? Yes, so this difference will result in a deferred tax asset. And increase, since it's the beginning, like what we should say, increase in deferred tax asset will lead to increased deferred asset is a debit or is a credit? It's a debit. So you have the credit deferred tax benefit, right? So what's on the income statement will be a credit. Credit is a benefit. Just like when revenue goes up, the benefit. When the gain goes up, it's a credit, right? So this is a temporary difference. That's the first thing we need to decide, because it's a permanent difference. Then there will be no deferred tax assets or liability, right? And then this is a deductible difference. That's important. And the deductible difference will lead to a deferred tax assets, and the increase in deferred tax assets, okay, this is very important, will lead to deferred tax benefit because, so we do not want to get into the box, right? Just have a glimpse of how messy the real world is. So the deferred tax asset here due to deferred tax benefit, but it's only increase. When deferred tax asset decrease, you will get deferred tax expense. Yeah, don't forget that when the reverse is the opposite. Okay, so that's that. So this one, non-deductible expenses are incurred in obtaining income that is exempted from taxes. Non-deductible expenses are incurred in obtaining income that is exempted from taxes. It's a permanent difference, absolutely. So it's a permanent difference. This is a permanent difference. Actually, so they only mentioned the non-deductible expenses. Well, this is expenses. What do we need to are permanent differences because they mentioned plural. What needs to be adjusted? So we should add this different non-deductible expenses back, but we also should subtract tax exempted income, both, right? So the non-deductible expenses, non-deductible expenses should be added, and the tax exempted income should be added, should be subtracted from accounting income to determine taxable income. Let's go one step further. That's just very clearly, there will be no deferred tax asset or liability from these differences. Permanent difference does not give rise to deferred tax. Okay.
So just a question here. If the income was not exempt from tax, it's still a permanent difference, but we would not subtract the income.
Yeah, we just need to add deferred, add this expenses. Okay. Here's one. Costs of guarantees and the warranties are estimated and accrued for financial reporting purposes. Is this temporary difference or is it permanent difference? We know warranties and guarantees, right?
Yeah.
Yeah. It's temporary difference. So we estimate how much it will cost us upfront to recognize it, but later on, when we actually have to pay for those costs, when warranty, like they come back to have the things replaced or repaired, you know, you have to pay for the replaced items or pay for the labors to repair it, all that, right? So this is a temporary difference. Make sense? Yeah, this is temporary difference. And the next, yes, temporary. Mary, you are right. So this is temporary difference. And the next one is Is this taxable difference or deductible difference? Deductible, right? Because when you paid, you don't recognize the expense anymore, but the amount paid is tax deductible. So in the future, the accounting income and taxable income will be different. Taxable income will be less as a result of this. The expense is recognized now and is tax deductible in the future. So that means future, ignore all the other differences. In the future, as a result of that, taxable income will be less than accounting income. But in the current period, the taxable income is higher than accounting income, right? For accounting purpose, you can deduct this warranty expense, but for taxable purpose, you can't deduct because cash payment is not made yet. Does it make sense? Yeah, so this is a deductible temporary difference. And if it's deductible temporary difference, it means it will result in a deferred tax asset. An increase in deferred tax asset. Yeah. Will lead to deferred tax benefit. Yeah. Okay. Now, okay. Let's go back to this. I meant to point out one thing I forgot. Let's go back to this. When the landlord collects the rents in advance, what if it's a tenant pay rent in advance? They will be the opposite. Yeah. Okay, so when we do solve the problem, we need to pay attention, right? So don't, when you see rent automatically, you say, oh, that's because that's rent. We review this, so that's a deductible difference. No, that's only for the landlord. If it's a tenant, it will be the opposite. Tenant will have deferred tax liability, right? Because the whole amount will be tax deductible right away, and the difference will be added to future. So just be paid. Just want to point that out. Installment. We did installment today, so we'll skip that one. We'll do the one that we didn't do today. Okay, two more. This one. The company reported dividends received from taxable Canadian corporation as investment income on its income statement, even though dividends are non-taxable. This is a permanent difference. Okay, the amount should be subtracted from accounting income to determine taxable income. There will be no deferred tax from this one. No deferred tax liability or asset, and therefore no deferred tax expense or benefit from that one. One last one. This one we didn't see before, but it's good to step out of their beaten path once in a while. So estimated loss on a pending lawsuit and the claims are accrued for financial reporting purpose. These losses are tax deductible in the period when the related liabilities are settled. First of all, is it a permanent or temporary difference? Yes, absolutely. So it's a permanent difference or is it temporary? Because if there is indeed a loss, it's tax deductible when the loss is settled, right? So this is a temporary. Huge. That's a huge. Be that big. So this is a temporary difference. Next, is it a taxable or deductible difference? Impact on the future taxable income. Would it increase future taxable income or decrease future taxable income? Will the difference be deducted in the future or be added in the future? Yes. Oh, I just look at that somewhere. I'm sorry, I'm looking at the chat answer. So as I said, it will be tax deductible in the period when the related liability are settled. So all the expenses are recognized now, but in the future, when the liability is settled, means when the payment is made, there will be no legal expense anymore, right? Instead, because the expense is recognized, but you can deduct the payment from your taxable income, right? So this is a future, this is a deductible temporary difference. So the future taxable income will be reduced when the difference reversed, means when the payment is made, right? So does it make sense?
So right now, the accounting income is less than taxable income, and then later
Yes. Exactly, right on, right? So therefore, yes, this is like a really important part. Once we figure this part out, if we kind of know the two type of difference leads to two type of account on the balance sheet, we are almost there, right? So deductible difference give you deferred tax assets, taxable difference give you deferred tax liability. That you have to know. And from there on, you just follow the logic, right? So this difference gives rise to deferred tax liability. Deductible deferred assets. Yeah. And increase in deferred tax assets will lead to deferred tax benefit. Okay. Yes, awesome. So so that's a good place to stop. That's a good place to stop. So I think this will be just pretty, unless you have a question up, in the process of doing your assignments, but we have one more class. We'll review the first two chapters, chapter 16 and 17. Okay. All righty.